Warren Buffett is almost universally loved as the Oracle of Omaha, but not all of his investments have come out all sunshine and lollipops. In fact, Buffett lost nearly $1.7 billion on just one stock, recently selling out of his shares. In this video, I'll reveal the 3 warning signs and ways to avoid a bad investment. We're talking Warren Buffett's worst investment today on Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in our community. Thank you for taking a part of your day to be with us. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, we've looked at some amazing Warren Buffett investments in our 4-part series here on YouTube, from his largest investment to some surprising bets in different industries. To this point, we've focused on replicating the Oracle's almost magical style of stock picking to be better investors. But this video, we'll be looking at one of Buffett's biggest investment mistakes, a bet that wiped out billions from the Berkshire Hathaway portfolio. We'll look at what happened, and I'll reveal 3 warning signs to keep you from making the same mistake. Don't forget to click through the Warren Buffett Stocks playlist I've linked in the video description below to check out all those videos. By late 2011, IBM had rebounded from the financial crash and was hitting all-time highs. The company had transformed itself during the first decade of the century and looked like it was going to be a leader for decades more to come. Now, Buffett had never been a tech investor and was on record many times saying that he knew nothing about the sector, that it changed too fast to give him confidence in cash flows. But in 2011, he told reporters he thought IBM had a big advantage in finding and keeping clients, with "It's a big deal for IT departments to move away from using IBM." So he liked that continuity and thought it was something like the stable cash flows he got from insurance companies and consumer staple stocks. And at first it seemed like the investment paid off. Shares surged to over $210 in 2013 from just $175 per share through 2011. But that's when it started to turn south. Buffett completed his final purchase in the first quarter of 2016 with an average price around $173 and a total cost of about $14.1 billion. According to SEC disclosures, he sold his position through most of 2017, where the stock traded for an average of $153 a share through the year. That's about a 12% loss, which would mean $1.7 billion of that $14 billion total investment. Now, fortunately for Buffett and the Berkshire portfolio, the investment collected $29 per share in dividends, so he might have come out about a 5% gain all told. But remember, this was over 6 years. A total gain of 5% over 6 years is not something that's going to make you rich. Now, you'll hear a lot of reasons why the investment failed, like Buffett investing outside his core sectors of financials and consumer goods, but I don't buy it. He's invested outside these sectors before and has a team of analysts in every sector to help him. I think there are really 3 reasons the deal went bad and 3 signs you can watch for in bad investments. Buffett focused heavily on the company's history of 5-year roadmaps and successfully meeting those goals, but he overlooked new challenges for new CEO Ginni Rometty in positioning for cloud services and exiting some of those legacy businesses. Buffett has always invested in good management and praised former CEOs Gerstner and Palmisano for turning the company around, and credited management with a real reason he was buying in 2011. One problem here seems that incoming management just couldn't live up to the standards set by that past management. To meet earnings goals, IBM was forced into major cuts that hurt morale and never really took the lead in cloud like it had in traditional IT services. Management tried to paper over these plunging sales with share buybacks, and even the Oracle of Omaha fell for it, but it couldn't hide the weakness forever. From 2010 through 2014, the company paid out more in dividends and buybacks than its free cash flow, and it had to fund all this with $20.6 billion in debt over the 8 years through 2017. In fact, the company was spending so much on buybacks that it forgot what made it a tech leader in the first place. Spending on R&D fell flat, and the company wasn't able to innovate like it always had. Buffett chased the shares lower, buying more IBM in 2015, even after it had fallen about 35% from that 2013 high. So what did Buffett do wrong here, and how can you keep from making your own monumental investing mistakes? First, if past performance is your reason for investing, you better have a very good reason to believe it's going to continue. Now, this is especially dangerous around management transitions, and you really can't assume anything. Sure, companies have economic moats in their brand, in market scale, and even in good management, but you have to honestly ask yourself if it's a defensible moat and whether things have changed. Another warning sign here to a bad investment, and I love buybacks and dividends, but operational cash flow is king. Okay, the first financial statement I ever look at is the statement of cash flows. While everyone else is looking at earnings per share for a company, I'm looking at how much actual cash was generated from the business. You see, management can manipulate earnings by holding off on booking some expenses or taking a smaller depreciation expense or even moving forward sales that actually won't be made for months. All this can distort earnings, but it's much more difficult to do this with actual cash flow. So I'm looking at how much cash the company is generating from operations, how much it's spending on R&D, and how much debt it's taking on, and that free cash flow. Finally here is don't try catching a falling knife. Now there's a sad saying in investing that if I liked it at 100, I love it at 90. It means you keep investing more money as the stock price falls. Some investors are going to tell you that this is called dollar cost averaging and that you only need the shares to rebound a little to make money. I call it a fast way to lose your money. The problem is that one investment can very quickly become a very large part of your portfolio as you keep putting more money into the stock as it drops. Buffett is known for making big investments. Now, Apple is more than 11% of his Berkshire portfolio, but he has an investment committee to hold him back. If you follow a stock down, there's nothing to keep you from pouring more money in after it, just trying to get even. Pretty soon you're holding shares of a bankrupt company that has taken almost your entire nest egg with it. You absolutely must have limits on how much you invest in a company and when to cut your losses. For most investors, I would say never have more than 5% of your stock portfolio in a single company. That means you're not going to have more than 2 or 3% of your total wealth in that company, since some of your money is in bonds and real estate for diversification. Losing that 2 or 3% sucks when a company goes bankrupt, but it really beats the hell out of telling your spouse that you blew the whole retirement savings on one bad investment. Now, just these 3 warning signs are going to help you avoid some of the worst investment mistakes, but they're not the only ones you need to watch for. If you haven't watched our special playlist on how to get started investing, there are a few videos there where I reveal some of the biggest lessons I learned as an equity analyst for venture capital and private investors. Click on the link in the video description below to watch all the videos in the Warren Buffett playlist, and don't forget to subscribe to the channel. We're here Mondays and Wednesdays with the best videos on beating debt, making more money, and just making your money work for you. If you've got a question about investing or about money, just scroll down and ask it in the comments, and I'll answer it in a future video.